One other thing to bear in mind is that when you're fundraising, you're not competing against your competitors. You're competing against everybody else who's fundraising at a similar stage. And so your ability to think about running a tight process, which I'm going to talk about at the end of this presentation, and iterating on your deck continuously is going to have a profound impact on how polished you look when you're talking to an investor. Most founders will iterate on their deck and their narrative as they are meeting investors. I'm a big proponent of not meeting with investors when they ask to sit down with you, like at all. Someone asks you if they could take a meeting, do not meet with them. Say no. And instead say, right now, we're not capital constrained, and we'll let you know if we open a process or when we open a process. The reason you want to do that is because you want to meet with just founders for the first month before you sit down with investors. So leading with product is really important. This is how our sensors work. This is like what our sensors see. And it demonstrates sort of the complexity of the problem that we have to solve and the simplicity of our solution by showing weird human behavior. The reason these things are helpful is that they really ground someone who's looking to write a check in who the hell you are and what the hell you do, instead of in abstract concepts about TAM. You've noticed I have not talked about TAM. I've only talked about product. I've only talked about people. And that's because these are things that we think have like a material bearing on who we are and what the value is to a customer. Typically show a bit more about machine learning. By the way, I have some of my own advice on what I might improve here. If you have great numbers, lead with your numbers. There's another really good piece of advice. I had buried the numbers, and in fact, I think this might be a dated deck. This became like our fourth slide, I think. The macro was COVID had hit, and it was accelerating the urgency and compressing sales cycles, and we had grown really materially month over month or quarter over quarter. And it was because the pandemic had increase the urgency by which people had cared about how people were using space. Now, the one thing to bear in mind here is that while the pandemic was having that impact, we were already on track to grow by hundreds of percentage points quarter over quarter. The thing that was really important is that it went further than that, and our sales were not interrupted by the pandemic. And so this is as much about showing that you have sort of contextual awareness of like the market that you're in and what's going on, and are doing objection handling ahead of when questions come up. Again, if you have good data, lead with the data. Our TCV to CAC it was really good and substantially larger than what sort of industry standard or best practices are. And so we just kind of show that. Here's what our payback period is. Here's when our customers pay. Here's our cost to acquire relative to the average deal size. The reason this is useful is you're raising capital to do something. So if you don't understand sort of like what you're going to do with that capital, it makes it substantially harder to raise because you can't really justify where you're going to spend it. The reason you invest is because you're trying to put, ideally, fuel on a fire. Now, this changes depending on the stage. So earlier stage is more a bet on the team. Mid-stage or late early stage is more a bet on early product. Mid-stage, it's more a bet on early traction. Call it mid to late stage. Before growth, it's on repeatable economics. So like you can actually do this. And that's where these numbers start to become really relevant, is how can you take my dollars and triple or quadruple? Again, if you have good numbers, lead with numbers. Like pipeline growth was really material, and it was really important that the pandemic, we raised a $51 million Series C in the middle of a pandemic. Our round was open for about 9 days. That's the soundbite. And that's what everyone goes, that's really cool. Like that's a lot of money, and it's over a very short period of time. The reality is that preceding that 9 days was 60 days of prep. It was dozens and dozens and dozens of meetings with founders to get feedback on this deck, which is now a year and change old. It was repeatedly, it was hundreds of slides that got deleted. A really good piece of advice I once got was, you should love every slide in your deck. And by love, a good way to think about this is that if I go to the next slide, am I like, oh yeah, I forgot to tell you, we grew at a certain rate, year over year. Or, oh, I forgot to tell you that ARR is also growing, not just TCV. Oh man, I forgot to show you this like really amazing net dollar retention number that we have. Now, we're a later stage company. You don't need to have all of these metrics. Early stage, you're looking at, call it 11 to 12 slides. You should love every single one of them. And if you don't, delete it. You could put it in appendix if you'd like. You can throw it in like sort of toss it in an archive area if you'd like. But my general recommendation is that like at the end of a process, you should truly love your deck And you should have pitched it so many times that it's fun to tell the story. I also want to point out a couple things. So this is an example of a barbell strategy. So a good way to think about your deck design, you want very high dense slides like this one, where you're not going to read everything. It's just not possible to read everything. High density slides. And then you want very sparse slides. And I'll give you an example of that. Like this is an example of a very sparse slide. Now, the reason you want this barbell strategy and nothing in between, no bullets, like very few bullets, is because you never want to read your slide in a pitch. Instead, you want them to be prompts. So this accumulating advantage is actually a term that Keith Raboy uses quite a bit. It is I believe the technical term for a network effect. The more common term is network effect, but there's a variety of terminology. Like in our case, we have bidirectional network effects, where like one thing affects it positively and the other thing affects it positively. And talking about it as an accumulating advantage was something that we learned in prep. So back in 2017, I was preparing for a Founders Fund meeting, and I was doing a bunch of research on Founders Fund, and I came across, he wasn't at Founders Fund at the time, I came across a Keith Raboy interview where he talked about network effects and the definition of an accumulating advantage. And I because he was at PayPal, I sort of assumed that the language, or the lingua franca, or whatever the term is, sort of the native language would sort of carry over. And he talked about like what are your accumulating advantages? And so that became the name of the slide, because I was on YouTube just sort of listening to a podcast that, who knows, maybe it was on This Week in Startups, with Keith Raboy talking about what a network effect actually is and why it's important. The reason that's useful is you're essentially like, so YouTube is the best podcasting service in the world. Just pay for the YouTube premium system. And what you can do is just listen to the audio instead of watch the video with like your screen off, which you can't do with the free version of YouTube. And so it becomes this huge list of essentially audio only files that you can listen to. And before you go into a meeting with an investor, and I'm going to talk about sort of the process in a second, I strongly encourage you to spend the couple days prior or the week prior just going on YouTube and searching their name. Listen to everything they've done. And what it will do is it will give you language to explain what you were already going to explain that they're familiar with. And that has a profound impact on how it's received. So Founders Fund led around, I don't think it's necessarily because of this slide, but because we were able to sort of talk in holistic terms about things like, you know, we believe in that we are building, sort of working in a small market, meaning a market that is growing really rapidly, but not one that is owned by an incumbent. The reason that's valuable when you're talking to Founders Fund is because Founders Fund believes in small markets and drawing concentric circles around ownership of a small market, such that you can become a more dominant force long term. You know, the DJI owns 71% of the drone market, even though it feels like there's lots of drone companies. How do they do that? So anyway, use the language of the investors that you're speaking with. Let me just back up a little bit. Then we get to market. And again, this is barbell strategy. It's a dense slide. I really call out two things, which is I don't know how many, we count people above points of entry and in open areas. And I don't know how many doors there are in the world, but there are a lot. And instead of trying to build a total addressable market by looking up some Gartner report, I strongly encourage, Mark Andreessen has this great comment, which is like, count your customers' noses. So count noses. It means go find your customers, your whatever customer segment, then go find the lookalikes of those customers and count them. That's your TAM. And that's a much better way of building a TAM than going and saying, well, the IoT industry is going to grow by 23% according to, you know, whatever bullshit report you find. Instead, like, just do the work of counting how big that is. Now, we struggle with counting the number of points of entry in the world or the amount of square feet in the world. I know that real estate is $280 trillion. It's a $280 trillion asset class. But the point is that physical space is completely unmeasured. So what I typically say here is, the crazy thing is that for thousands of years, we've been building buildings without knowing how they get used. The state of the art today is an architecture grad student with a clipboard or an iPad wandering around physical space for 5 days a quarter and noting down that room is in use. That desk has not been touched, or that bank of desks has not been touched in the last few days. That's how we've been building buildings. And, you know, what would happen if New York City all of a sudden knew how it was used? Would it design itself differently? And we think that the answer is objectively yes. So the question isn't a technology problem. The technology is a very important part of the problem. The real problem is a distribution problem. How do you get an intelligent device into every relevant room in the world? And whoever solves that problem earns the right to remake it, earns the right to assist in its editing. And so the TAM is the surface of the earth. It's all built physical structures. Now, that sounds stupid. That sounds like a Silicon Valleyism. You know, I live in San Francisco, but like, it's very easy to get wrapped up in the concept of like world-changing stuff. If you believe it, however, and if you are really enthusiastic about why, and the logic is sound, it is impossible to argue with ambition. And so I would encourage you to be ambitious, but be genuine in it. In this case, these are the numbers. There's $1 trillion of space in offices alone that people have bought, used, leased, otherwise occupied, and are not using at all. Like, it's the desk that doesn't have anybody in it. It's the conference room that doesn't have anybody in it. And the reason that's useful is it clearly articulates it's a very big problem and it's a very large potential market, even if it's still nascent. I strongly encourage you to talk about competition, not as competition, but as competing technologies or competing products. The reality is that you are competing with more than your competitors. You're competing with doing nothing. You're competing with really good marketing. You're competing with incumbents that say they do something but don't. Saying that you don't compete is a non-answer. Saying that you compete and saying, or that there are competing products and values and intents is a much more reasonable position to take. Strongly encourage a logo slide if you have great logos. Don't make them like all over the place. Give them a little bit of order. Use cases, make sure you make it really clear. I know I said no bullets, but like really you don't want to be reading bullets, so keep the bullets to a minimum. In this case, I don't talk about each of these, but I do talk about the use cases. And I also talk about how the difference in the macro pre-COVID and post-COVID. You have to remember, this is literally like March, April, May of last year. So COVID and the pandemic was a big part of essentially all fundraising. Today, it's maybe a little bit less so, but how is that affecting use cases and where people spend, why they're spending their dollars? Strongly encourage big imagery if you have it, full imagery. Again, this is sort of barbell strategy. The point that I make here is that our primary value is in the software that we build. It's not in the physical devices. Talk about actual growth from an actual customer. Customer stories speak volumes. So this had to do with the growth of 154 floors, 67 buildings, nationwide deployment across millions of square feet of space. And then sort of a concluding statement. I'm reasonably sure that there's not a future in which humans continue to build buildings or use buildings, but don't know how they're used. In this case, the pandemic has just accelerated the timeline. But the point is that there's this great quote, and I believe it's from the founder of Big Screen VR, I think. He essentially said, tweeted once that your job as a founder is to not die for long enough for the market to notice you. And I really love that because it's not saying, it makes clear that the point that time is such a huge, it's so important to whether or not you succeed or fail, that not dying is just as important as building a great product sometimes.